So let's talk about a company that, on the surface, sells things like dental tools and demolition robots. But if you look deeper, its real business isn't making things at all. At its core, Lifco is a machine, and it's a machine designed for one specific purpose: to acquire great companies and compound their value over time. It's almost like a form of financial alchemy. And for any investor, I think understanding how this machine is built, and more importantly, how it holds up under pressure, is a fantastic lesson in capital allocation. So let's pop the hood and see exactly how this thing works. Here's how we're going to break it down. First, we'll dig into the core philosophy that makes the whole thing tick. Then, we'll look at its really unusual blueprint. After that, we'll see the value creation engine in action and, really put it to the test with some real-world data. And finally, we'll get to the tough question that all of this leaves for an investor. Let's just kick things off with a pretty simple but kind of wild idea that's at the heart of Lifco. What if a public company decided its main business wasn't going to be making stuff, but instead just buying the companies that do? And then, and this is the key part, committing to never, ever sell them. It sounds so simple, but the implications of that one decision are just huge. And that brings us to the core identity of this Lifco machine. See, it's not just a buyer. It very specifically brands itself as a permanent home, a kind of safe haven for the entrepreneurs that it buys from. This idea of being a perpetual owner is a world away from the usual private equity playbook. A PE firm has to flip a company every few years to make its returns. Lifco makes a completely different promise. So for a founder who's looking to retire, the pitch is incredibly compelling. Sell us your life's work and we promise we'll protect its legacy, not chop it up for a quick buck. That trust right there becomes a massive competitive advantage when they're out trying to find the best businesses to buy. Okay, so if your game plan is buy and hold forever, how on earth do you build a company that can actually pull that off at scale? Well, the answer is in Lifco's really different blueprint. We're talking about a deeply decentralized and unbelievably lean structure. 35. That's it. That is the entire corporate headquarters. No massive central marketing department, no bloated strategy teams, just a small, razor-sharp group of people focused on allocating capital. And get this, those 35 people are overseeing a portfolio of more than 257 separate companies. We're talking over 7,000 employees spread across 34 different countries. The sheer scale of that decentralization is it's staggering. And this isn't some accident or oversight. It is a very deliberate strategy. The CEO himself says his number one job is to act as a shield, to protect his companies from the kind of corporate red tape that just kills the entrepreneurial spark that made them great in the first place. And here's the crucial insight, right? This lean structure isn't a bug. It's a feature. It's a built-in quality filter. Think about it. With no big team at HQ to parachute in and fix a broken business, Lifco is forced to buy only the best, high-quality, profitable, well-run companies. It literally has no other choice. Okay, so we've got the philosophy, we've got this unique structure, but how does it all actually make money for shareholders? Well, it all feeds into the financial heart of the machine, a simple but incredibly powerful kind of arbitrage. It's basically a three-step playbook. First, Lifco uses its safe haven reputation to buy a fantastic private business, and they pay a disciplined price. Let's say 6 to 8 times its earnings. Second, that business gets tucked into the publicly traded Lifco portfolio. And then, well, here's the magic. The public market, which values Lifco as a whole at this premium multiple, think over 25 times earnings, it instantly re-rates that new stream of cash flow. An asset you just bought for 8 times earnings is suddenly being valued at 25 times. Boom. Value is created for shareholders like on day one. So from an investor's perspective, this is the whole game right here. Lifco's real product isn't a physical thing, it's a financial process. It is a machine that is just incredibly efficient at sourcing private assets at a discount and then transforming them into publicly traded assets at a premium. All right, that all sounds great on paper, doesn't it? But theory is one thing and performance is another. So let's see how this machine actually held up when things got tough during the economic slowdown in 2024. This was a real-world stress test. So, this table really tells the story. It splits Lifco's growth into its two engines. Now look at that acquisitions column. It's remarkably steady, just chugging along, delivering somewhere between 9 and 18% growth year in, year out. But then look at the organic column. It's way more volatile.
It can rocket up 21% in a great year like 2021, but it can also drop to -4% when things slow down, which is exactly what we saw in 2024.
And if you zoom in on 2024, it's crystal clear. The organic engine, the actual core businesses, it actually shrank by 4%. But that M&A engine just kept humming, adding a fresh 9% of growth. This is the whole dual engine model in action. The reliable acquisitions engine kept the company's earnings moving up, even while its existing businesses took a hit. But, this organic weakness, it started to create some real fear in the market. The big question, the whole bear case really, was this. Was this just a temporary, cyclical dip? Or had the company just gotten too big, too complex to manage? Was that super lean, hands-off headquarters now actually a liability, unable to fix this operational drag across its huge portfolio? So, as the stock price was sliding and the market was getting nervous, how did the people who know the company best, its own management team, respond to all this fear? Well, they put their own money where their mouth was, big time. The CEO, Per Waldemarson, went out and personally bought 37 million kroner worth of Lifco stock. Now, this wasn't some corporate share buyback. This was a massive personal wager that the market had it all wrong and that this operational drag was just temporary. For an investor, you just can't get a much louder signal than that. And all of this brings us to the final dilemma for anyone looking at this stock today. It really all boils down to two very different stories about what happens next for Lifco. So, on one hand, you have the bull case. This is a best-in-class compounding machine, period. The 2024 weakness was just a cycle, proven by the recovery that followed, and that huge insider buy from the CEO. And with low debt, that M&A engine still has tons of fuel in the tank. But on the other hand, you have the bear case. They'd say this company is a victim of its own success. That hands-off model can't fix the drag, competition for new deals is only getting fiercer, and the stock is priced for absolute perfection, leaving zero room for any mistakes. So that's the core dilemma right there. Is Lifco a truly resilient compounding machine that has proven it deserves its premium price tag? Or is it a fantastic success story that's finally maybe just bumping up against the natural limits of its own unique model? For any investor, that is the billion-dollar question you have to answer.